I'm Kyle with Fundamentals of Finance, and I'd like to welcome you to my next video where I'll go through a topic I know is on a lot of your minds right now: how to invest in recessions. Keep in mind, this is not financial advice and it is my opinion only. Just to set the stage for anyone that's a few years removed from their economics classes, a recession means 2 consecutive quarters of negative GDP growth. Or put more simply, 2 quarters in a row that the economy overall doesn't produce as much stuff as it did in the prior quarter. Now, from an investment perspective, if you're expecting a magic bullet like just invest in this exact type of stock and it'll do great in every recession, I'm sorry to disappoint you, but that's just not how things work in real life. If someone else tells you that they do have a simple, foolproof solution like that, they're either full of crap or just have no idea what they're talking about. What you'll get here at Fundamentals of Finance is the unedited truth, even if it's not the simple truth that we wish it was. So let's start by briefly looking at why I'm putting this video out now. You may have guessed it. It's because a lot of people think we're headed into a recession. In fact, I heard recently that economist Cardi B said we're already in one. And how can you get any more reliable information than that? So fine, it's trending and everyone's talking about it. But what does a recession really mean for your investments? Well, that's what we're here to discuss. By the way, I actually don't know if we're heading into a recession. It's certainly an interesting discussion topic, and I'll touch on it briefly. But one of the key lessons you'll learn in this video is why. From an investment perspective, it really doesn't matter that much if we go into recession or not from where we are today. There's an old joke that economists have predicted 9 out of the last 5 recessions, meaning economists predict recessions all the time, but often in reality, it doesn't really pan out. Although to be fair, I like to think that at least I'm a little bit closer to being an economist than Cardi B. We're going to focus mostly on investing in this video, but in short, the reason most people think we're headed into recession is because inflation is really high and the Fed will have to raise rates a lot to get it down, which will push the economy into recession. This is especially true this time because when the Fed raises rates, it impacts demand, but the inflation right now has been largely driven by not enough supply rather than too much demand. So the thought process is that demand will have to come down a lot to get inflation down. And if demand is falling a lot, then people aren't buying as much stuff, and if people aren't buying as much stuff, then companies aren't making as much money. The falling production and consumption is essentially a recession. That's certainly a legitimate case, but a lot of the key recession indicators just aren't flashing red yet. For example, every recession in the last 50 years was preceded by an inversion of the yield curve at either 10-year, 1-year spreads or the 10-year, 3-month spread. The yield curve just shows what different maturities of US Treasury bonds pay in interest rates at any given time, and usually the line goes up like this, meaning that longer-term bonds pay higher interest rates. If it inverts, that means that the shorter-term bonds are paying higher interest rates. But you can see that right now the 10-year yield is much higher than the 3-month yield or the 1-year yield. So the yield curve is called normal and is not telling us that a recession is imminent. You also still have a really strong job market with a low unemployment rate. A PMI of over 50 shows us that manufacturing is still strong, real estate is still doing well, consumer confidence is still high. So could we have a recession in the next couple of years? Sure, that wouldn't surprise me at all. But I'm not as confident as Cardi B that we're in one or heading into one in the next couple months. A recession in 2023 or 2024 is quite a realistic possibility, but a lot can happen between now and then, so it's not really a foregone conclusion. The key message I'm going to keep repeating though is that from an investment perspective, it really doesn't matter that much if we technically enter a recession or not. I know the term recession can be scary, especially since the only 2 that most of you probably remember are 2008 and 2020. And those were especially bad ones. But most recessions just involve things slowing down, not the risk of a collapsing global financial system or the end of the human race. Given the strength of the consumer, the job market, and corporate balance sheets, if we do have a recession, it's likely to be relatively mild. To me, the biggest risk to that is the removal of quantitative easing, which is just a fancy term that means the Federal Reserve has been buying US bonds, a lot of them, to help support the economy. The removal of quantitative easing is called quantitative tightening, and QE and QT are supposed to work similarly to lowering and raising interest rates to ease or tighten financial conditions. You may remember the little trick I gave you to remember this in my inflation video. QT and raising interest rates are ways to tighten monetary policy by making it harder for companies to borrow money. Like how you might tell your friends, sorry, I can't go out this weekend, money is tight right now. The reason I mentioned that this is the biggest risk to the only a mild recession scenario is that QT hasn't really been tested on the scale that they're planning. They did a little in 2018 and 2019, but then resumed QE at a massive scale in 2020. That played a big part in saving the economy, just like it did in 2009, but no one really knows how much impact it'll have when it goes the other way at a more aggressive pace. It's set to start this month though, June 2022, and then pick up speed in September. So we'll soon find out. If you're interested in me doing a full video unpacking quantitative easing and quantitative tightening, let me know in the comments and I'll put one together. But for now, let's finally move on to how to invest in a recession. Since I mentioned it twice now, I probably should start with why it doesn't matter that much from here, whether we go into a recession or not. A recession refers to the economy, but we don't invest in the economy. We invest in the stock market or bond market. The markets are forward-looking, meaning they price in what's expected to happen. So if everyone already expects a recession, the stock market will probably have already sold off. As of the time of this writing, mid-June 2022, it has. Could it fall further? Yes, of course. But often the stock market will start falling before we enter a recession. And then it takes 2 quarters or 6 months for a recession to be official. And then since it takes a while to compile economic data, it'll be another few months after that before we know we are in a recession. By then, it might already be over. And just like how the stock market usually starts falling before the recession starts, it also often starts going back up before the recession ends. You can see an example of this in 2008, where the market peaked out in October 2007, but the recession didn't start until 2008. Then the market hit its bottom in March 2009, but the recession continued a few months longer. It's really hard to invest around a recession unless you're predicting one before most other people are. And I don't think you are today. But this video will live on beyond 2022, and recession-driven stock market downturns often last more than a year. So if you think recession is coming, here's how to think about it. At a high level, and where most overly simplified explanations will stop, is that you should be invested in less cyclical and more defensive companies. Cyclical means that they do well when the economy is doing well and vice versa. For example, banks make money by lending. So if businesses aren't borrowing in a recession, that's not a good environment for them. Luxury goods like high-end cars would be another example. If you're worried about your job security, is now the best time to spend on that new BMW? Probably not. On the flip side, defensive businesses tend to hold up better than the overall economy when it's falling. That doesn't mean they go up, it just means that they might not go down as much. These would be really stable businesses that have lots of cash on their balance sheets and aren't really at much risk of losing a ton of business in the downturn. So utilities, for example, you'll probably cut a lot of expenses before you stop paying your electric bill. Consumer staples are another example. These are things people need, like basic food, clothing, toilet paper, toothpaste, or think they need, like tobacco. Things that people keep buying even if money is tighter. Healthcare and telecom are also good examples. These are things I would say are generally true in most downturns. But there are 2 considerations that are really important and could lead to exceptions. First, the cause of the recession is extremely important. You have to think about how much that will impact different kinds of businesses. Normally, consumer staples have been really stable, but Anheuser-Busch InBev, the largest beer company in the world, fell a lot in 2020 because bars were closed, obviously. Conversely, technology companies are usually not defensive at all in a recession. That was especially true in the 2001 recession, which was caused by the bursting of the tech bubble. But in 2020, everyone was locked inside and a lot of people were starting to work from home. So you bet it was time to upgrade that computer or buy a better TV or invest in a Zoom subscription. And a lot of tech companies experienced years of expected growth in a couple months, which sent their stock prices soaring. Ultra low interest rates didn't hurt either. I don't have a crystal ball, but my guess is that this next recession might be a bit different if it's just caused by high interest rates and inflation. So the first thing to consider is what is causing the recession. The second thing is what's priced in. Remember, the market is forward-looking. From where we are today in mid-June 2022, the market has already sold off a decent amount and some of these defensive sectors have already gotten really expensive. You can see in this chart from Bloomberg that as of May, defensives, meaning utilities and consumer staples in this case, were near their all-time high valuation relative to cyclicals, which are represented by financials and industrials. That means that if you'd had the foresight early in 2021 to say, you know what, all this money that's been pumped into the economy has got to go somewhere when they open back up. And a lot of companies haven't been producing much since they've been locked down. So I think inflation is going to go up by a lot and the Fed is going to have to raise rates aggressively, which is going to put us at risk of a recession. Then it would have been a great time to get defensive. But now you might have missed it. You didn't get those concert tickets right when they went on sale and now it's sold out. If you want to join the defensive party, you're going to pay very high prices. They might go higher still, but when Cardi B is talking about a recession, you're no longer early. But if you think a recession is coming or just want to be prepared in case one does, the easiest way to prepare your investments will be to find an actively managed mutual fund or ETF that takes a conservative approach, ideally with a specific objective to protect on the downside. There's no guarantee the portfolio managers will be right, but at least that way, you know you have professional managers analyzing the markets, thinking about what risks are coming, what's priced in, and what might be defensive this time around. You don't have to do it yourself. This is not a recommendation since I don't make those on this channel, and I just told you it might be too late to invest based on the possible recession, but a fund I like for any investor who might want to get defensive but stay invested in the stock market is American Fund's American Mutual Fund. According to the American Fund's website, it's managed for conservative growth and income investing and invests primarily in well-established companies with strong balance sheets and a history of consistently paying dividends, helping to provide downside resilience. If we unpack this piece by piece, well-established companies with strong balance sheets are often more stable. They're not on the brink of bankruptcy and have some cushion to make it through a slowdown. Companies with a lot of debt on their balance sheets might not be so lucky, especially in a rising rate environment like we're in now. A history of consistently paying dividends. Dividends, assuming they're sustainable, which they usually are in well-established companies with strong balance sheets, are often a source of stability in a downturn. Investors hate uncertainty, especially in volatile, scary, uncertain times. Dividends are often a more reliable source of return than earnings growth, which can fail in a recession. So dividend-paying companies often hold up better than non-dividend paying companies when the stock market is going down. Also, somewhat rare in the industry is that conservation of principal is one of its objectives in its prospectus, along with current income and growth of capital. It also has a more than 70-year track record of beating the S&P 500 in all kinds of stock market downturns, and some of the lowest expenses of any actively managed US equity fund. So while I don't know your situation, and I don't generally think it's a good idea to predict short-term market moves, this one I would have in my portfolio if I were a conservative investor that still needed some stock market exposure. I'm actually a very aggressive investor, but we'll have to save that for a future video. For now, I'll leave you with 3 key takeaways. First, it's not a foregone conclusion that we'll have a recession, but if we do, there's a good chance it'll be more mild than the last 2. Second, it's really hard and generally not advisable to invest based on when you think a recession is coming, especially if the market has already sold off a lot. And third, defensive businesses tend to hold up best in a recession, but it's important to consider what will drive a particular recession and what's already priced in. If you really want to learn how to invest, check out my free webinar below called The 9 Habits of Successful Investors. The link is in the description. Thank you for watching, and I will see you in the next video.